All right, everyone. 5:03 p.m. Let's get started today. Today, we have quite an exciting topic on hand. Right. Perhaps a few words of introduction first. My name is Jason. I'm part of the advisory team here at Syfe, and I have here with me Ritesh, who is actually our head of investment advisory. Ritesh, few words of introduction.
Hey, Jason, thanks for the introduction. Hi, everyone. Pleasure to be here. Very excited to cover this topic today. I think it is also close to my heart in terms of, how people think about investments and how you can do better. So, look forward to the session as it moves forward.
Yes, great, great. Same here as well, Ritesh. I am looking forward to today's session. We do have a lot to cover, I would say, and I'm very excited to get into it. So, a few housekeeping matters for those of you who have just joined us. We are having a portfolio pick at the end of today's session, so do stick around for that. We will be actually looking at live clients itself, so that will be pretty interesting. Same usual general housekeeping matters as well. If you do have questions, feel free to put it on the Q&A, right? We'll get to it at the end of the session as well, right? And yeah, let's begin then, shall we? All right, so today's agenda itself, pretty self-explanatory. We'll be going through understanding your key investment objectives, followed by goal-based investing. What do we exactly mean by that? A look into how we can actually do purpose-driven investing here at Syfe. And of course, finally, we'll end it off with portfolio picks of our actual clients itself. Right? So let's look at the poll questions, right? Okay. You should be looking at the results on your screen right now, right? And it is pretty interesting. So majority of our viewers actually, okay, so the first question, what assets do you currently hold in your portfolio? Majority of our participants actually mentioned equity funds. Right. Second one, what goals do you have in mind? I think majority of them actually are looking at capital growth, right? And of course, the last one, how confident are you with the optimization of our portfolio, which is the topic at hand today, right? And majority of them actually mentioned not confident. Oh dear. Right. Ritesh, any quick thoughts about that?
Yeah, I think good to see these results. In general, I feel that a lot of people, while they know instruments through which they can invest into the market, so you see a lot of like stocks, ETFs, funds, such categories. But when it comes to mapping these out in terms of goals and real solutions for their core, the core cost of those goals, I think it is very hard for people to map it out. So while people do have goals, I think they're not really sure if they are rightly aligned to those goals. And that's why, people are not sure whether their portfolios are optimized or not.
Definitely, yeah. And I think today we are going to go through a lot of that aspect, right, Ritesh?
Absolutely. So hope, I think through this session, we will be able to provide a little bit more insight for our attendees today to have some frameworks in place when it comes to investing and making investing really work for your goals.
All right. Ritesh, perhaps if I could trouble you to cover this section first while I try and settle my audio issues.
Sure, Jason, thanks. Hi, everyone. So let me just quickly introduce Syfe. A lot of you should be already clients of ours, so you should know who we are. But also there are a lot of people who must be joining us for the first time. So just for your knowledge, Syfe is a Singapore headquartered MAS and SFC licensed digital investment platform. We have a mission to make investments accessible to everyone, and we want to enable it through smart, affordable, and intuitive financial solutions. We move on to the next slide. And it's really a matter of having a platform that can do it all for you, right? Like, so whether you want to invest in managed solutions where you don't want to decide what to buy, how much to buy, and what proportions to buy, we have our wealth platform that offers pre-curated portfolios that are personalized to your specific long-term goals. We have those offerings for you. If you are someone who wants to also dabble into individual securities and invest with high conviction into certain sectors, then there is our trade platform through which you can invest into single stocks, ETFs, and in some markets, also crypto. So it's really a matter of giving you access to a one-stop solution that can solve for all your savings and investment needs. And this is what has enabled us to gain the trust of over 100,000 clients in Singapore. We started off in 2019. So if you go on to the next slide, you will see really our journey so far, right? So we launched in 2019. Since then, we kept on delivering very high quality products to you. That led us to raise new rounds of funding. So far we have raised 2 rounds post our initial launch, which is the Series A and Series B. And till date, we have north of $50 million that have come onto the platform to support us in building the next generation of wealth solutions for you. Most recently, we've launched our income plus portfolios, given what is happening in the fixed income space. Last year was very troublesome, but this year, given the highly attractive yields, it looks very promising investing into the fixed income world. And what we've been able to do is really partner with a leading investment house. When you talk about fixed income, PIMCO just naturally comes into mind. So our income plus portfolios powered by PIMCO is a unique partnership that we have been able to do and give you, again, access to very high quality investment solution. We move on. On top of that, safety is our priority. So I think most of you know, we are licensed by MAS. We have a capital market services license. And more importantly, what this license means for you is even more important in terms of how we keep your money safe. As part of the licensing, we are required to keep all client assets completely separate from our own assets. This helps in regards to unforeseen circumstances or situations. Not that we have any trouble, and as you could see, that we have very strategic backers. But if God forbid something happens to Syfe, because of these requirements, because of the bells and whistles in place as part of our licensing, your assets will be kept safe and you will be able to redeem them in full, right? And that's really because we have to keep client assets completely separate from our own assets. All right, so that was a quick introduction. Let's move on to the portfolio optimization section. This is where we will spend bulk of our time, and we will also try to allocate some time for Q&A, because we really want to hear from you what kind of things that you are trying to solve for, and how can we be helpful in helping you achieve your goals. So first things first, if you move on to the next slide, essentially, when it comes to the basics of investing, right? Like, when you are thinking, how do you make your money work harder, right? That basically entails for you to think about 3 basic aspects of investing. And these 3 basic aspects are you trying to get better savings? Are you trying to do, invest for income? Or are you looking to grow your wealth, right? So typically, either you are concerned about safety of your money, or you want to generate some sort of an income, or you want to grow your money, right? Like, these are typically the 3 fundamental building blocks of how people think about investing. And there is a natural progression, because someone who is very new to the market, they might not want to, directly go and invest into the stock market, into individual securities. It's a little bit too volatile for them. The natural evolution is someone who's been saving, right? Typically your risk appetite and everything is very low, and you want very high liquidity. So that's the savings bucket. You just want to enhance your yield, right? And there are instruments through which you can do it. On the income side, then what you do is, as you move this side, you're able to invest into bonds and other such instruments. And then when you go onto the capital growth side, you are looking to invest into high growth kind of investments that can have, much more risk in them, but over a longer time period, you're able to generate much better wealth accumulation. So typically savings, income, growth, the volatility shifts from low to high, the time horizon shifts from short to long, and even your risk appetite goes from low to high as well. Now, in terms of asset classes, when it comes to implementing each one of these buckets, if we go on to the next slide, there are different instruments and asset classes that can help you cater to these specific needs that you have, right? So there is cash when it comes to savings. You have savings account, you have your fixed deposits. In Singapore, you have SSBs and T-bills. typically these are your go-to products when it comes to savings and safety of your money and keeping it, relatively liquid. Now, obviously, with time, more investment opportunities have come under the fold, and what that means is now the options for you to invest within the cash bucket or the savings bucket have expanded to include money market funds that can actually give you a much better return without having your monies locked up and things like that. So we'll talk a little bit more on those aspects as we move forward. But in terms of, again, the savings bucket, you have really these options to dabble into. As you move to the more income side of things, you start to invest into bonds, fixed deposits as well. I mean, in terms of you can think of FDs to play a role on the cash side. They can also play a role on the income side as well. Then there are endowment policies and other such instruments through which you can invest into for generating income. And why these instruments? Because bonds, the way they are structured, you invest a certain amount into a certain company. You're really lending money to that company, and in exchange for them taking money from you, they're giving you some interest on a regular basis. So that's why they really cater to your income needs. And overall, what that means is, once you have provided that capital to them, at a certain point, they'll return that capital back to you. So the risk is relatively limited unless the other person defaults or the company defaults. Then as you move to the right, you see that there are other instruments. There is real estate. In more liquid form, we have REITs, and we, at Syfe provide an instrument for you to get exposure to REITs. REITs typically can cater to both income and capital growth needs, because REITs can, appreciate in value, but at the same time, they're required by law to give out 90% of their income as dividends to shareholders. So it can cater to your growth needs too. Similarly, on commodities, sometimes they might not be directly related to growth aspects, but they do act as hedges, right? For instruments such as gold, silver, some of these do act as hedge when it comes to, and giving you more uncorrelated returns when it comes to long-term investing. So typically they're part of a portfolio. And then really for your real growth needs, you can invest into stocks, equities, equity funds, ETFs. You can invest into managed portfolios and other such instruments. And as you move from one instrument to the other, what happens is your risk aspect changes, right? And we covered this previously as well. It is really about optimizing what you are trying to solve for and then balancing it in terms of the risk that you're willing to take, right? So on the cash side, the risk is the lowest, but the return is the lowest as well. Versus if you keep moving to bonds and then to diversified portfolios or ETFs, and then if you move on to individual stocks, the risk that you're taking keeps on going higher, but at the same time, your return or potential return that you can generate also moves higher. All right. So now, I guess, moving on to the next slide, it really focuses on how people should be thinking about investment, right? Typically, when you have these buckets defined of savings, income, and growth, you would just pick one bucket and then you will basically invest in a particular instrument to drive returns through that bucket. Typically, what that also means is that if you are, as an investor, you might not have a sole focus on one bucket and you want to invest into all the three buckets, but your priorities might be more geared towards one bucket. So typically what that means is you might need to have a balance between the three different objectives. And in order to have a balance, you might need to give up on certain aspects to be able to focus on those aspects, right? If you're trying to invest into more equity and high growth investments, then be ready for more volatility and risk taking as well. Versus if you're trying to solve, keep it relatively safe, then be ready to not have, very high returns in your portfolios, but it will be very stable on that matter. Now, in terms of how to map it out in a more structured manner, typically when we invest just with certain instruments, we are geared towards the returns of that instrument, right? And the risk tolerance level only. So these are the only two things that dominate our thinking process. So this is the traditional way of investing. When it comes to goal-based investing, it is basically to map out what your priorities are and then finding the correct balance between, the three key objectives that we talked about, which is basically your savings, income, and growth. So when you want to think about your investments in a more goal-oriented manner, then your focus is on total return outcomes or specific goals, such as generating a reliable source of income, right? So you need to really map out what your priorities are in terms of the goals that you want to achieve. And then the risk that you take isn't viewed as outperforming or underperforming a particular benchmark, because like when you invest just from a simple instrument standpoint, then all that you care about is this stock outperforming or underperforming, say S&P 500 or, a particular benchmark. But when you're thinking about a goal, then what you're really caring about is, will I fall short of my goal? You're trying to quantify that goal and you want to be able to achieve that goal. So the focus moves away from returns and outperformance, underperformance, and it moves more towards realization of your goals, right? And then the last point is, what do I need to do to ensure that I'm on track of these goals, right? So your investment strategy and everything is guided by the fact that whether you're able to achieve your goal or not, and if you're not, then what can you do to get back on track to achieve those goals? Because each of our goals usually have a cost associated with it, and if you want to really achieve those goals, then you need to balance it between your different priorities in life as well. All right, so that moves us into the goal-based investment framework, right? And within goal-based investing, we will try to focus on a few aspects, right? Like, how do you set your goal? Then how do you prioritize your goal? And then how do you actually start? So if you look at the typical journey of goal-based investing, it is really a step process between, starting off by identification of your goal, prioritization, mapping out your time horizon and risk assessment. Then it goes on to the asset allocation process, and then onto the monitoring and adjustments. On the identification side, the first step is really to clearly define your financial goals. And these could include like savings for your retirement, buying a house, funding your child's education, starting a business, or any other specific goals that you have in mind. Then once you have defined these goals or identified these goals, it is a matter of prioritization, right? And in terms of prioritization, you have to prioritize them in terms of urgency, right? Some goals can have longer time horizon, while some goals may have, you to take like more immediate action. So for example, if you want to buy a house and that goal is like, say, 12 months from now, you need to immediately prioritize all your savings and investing to make sure that you're able to cater to the down payment of that house, right? So that brings us to the point of time horizon. So you need to really define your goals in terms of short term, medium term, long term. And the time horizon does influence your investment strategy, your risk tolerance, and your asset allocation. So again, if you're investing for short term, then it is very unlikely for you to invest into very high risk investment, because if the time horizon is relatively short and the instrument or the investment strategy is very volatile, then you might not be able to have the goal achieved in a more certain manner, and you might fall short if the market moves against you. So that basically brings us to the point of risk tolerance, right? And that is crucial in determining what the appropriate investment approach is for each goal that you have in mind. And some goals might allow for higher risk investments to pursue higher returns, while others may require you to take a more conservative strategy. And once you have done all of that, essentially, the next step is for you to then diversify and allocate your portfolio across stocks, bond, REITs, real estate, cash, and other such components. And once you have defined all of this, I think the job just starts, and that's the real time when you then automate your investments and then monitor it on a regular basis to see if there is any adjustments that need to be made. All right, so if you go on to the next slide, I think it maps out a little bit on how do you define your goals. So you really need to start by, thinking through how long will they last and how much will they cost, right? Each of these goals, and divide them into different buckets based on their time horizon. For example, again, like if you're paying for your child's college expenses, buying a home, retirement, legacy planning, these are all different kind of goals, and they have different costs associated, and plus they have different time horizons. In terms of, how do you prioritize, that I think then comes off to the fact that maybe you cannot afford it all, right? So if you have limited sort of resources at your hand in terms of, what you can reasonably achieve, it is important to set your priorities that can help determine what kind of trade-offs need to be made in terms of, these different goals. You really need to decide how much of your current assets and future savings to put towards these different goals based on their relative importance. So, for example, if your child's education is a top priority, would you consider delaying your retirement, right? Or spend less in retirement if needed, right? So these are the kind of trade-offs that you might need to make when you're really trying to think through all your goals and then trying to, prioritize them. Once you have done that, then basically it comes down to aligning your investment strategy by the goal based on your risk tolerance and the investment time horizon, so that really you can take like time to your advantage. So if you go on to the next slide, I think it talks a little bit more about how do you define your investment time horizon and use it to kind of determine your asset allocation, right? So typically, if you have a longer time horizon, your risk-taking capability increases, right? And as you see from this particular graph, the shorter the time horizon, your allocation is much more geared towards a conservative allocation towards, stocks, and a much higher allocation towards bonds. But as your investment time horizon increases, you can invest into, more more return generating sort of asset classes. They might be more volatile, but the fact is that if you don't need the money in the next 10 years, you would want to maximize your returns. And that basically means that you give your money greater time to compound over time and go through different, economic cycles and all as well. In terms of like, just determining for yourself what could be the asset allocation, and, like some people don't even understand that, okay, between the duration and risk, like where do I stand? A general rule of thumb could be to think about your age and do 110 minus your age. That can be like a thumb rule. Now, again, this is not the best way to decide your allocation. Ideally, you should be speaking to an advisor to really map out your exact goals and your investment preferences to determine what is the right allocation that suits you. But generally, if you want to have a mental math, then this could be a way for you to think about it. So if you're a 40-year-old, then 110 minus 40 is basically 70. So you arrive roughly at that, growth bucket where you have allocation of around 70% stocks and around 30% bonds. Now, once you have decided what your asset allocation looks like, it comes down to security selection and deciding an approach to your investments. Now, typically, there are different investment styles, right? And the two main ones are having an active approach, and the second one is having a more passive approach. In passive investing, you typically try to track the overall performance of the market, and you usually do it through index funds, right? So you don't try to outperform. Your real importance is to track market performance and do it at relatively low cost and high efficiency. And index funds usually, and ETFs to that matter, are really securities that enable you to be able to get the exposure to the market and track the performance of the market without incurring too much high cost. On the other hand, active funds, they seek to outperform the market and they seek to generate alpha for you. And they focus on security selection or market timing, right? So these are typically the strategies that people would follow in terms of determining, how they approach their investments, right? Like once you have determined your asset allocation in terms of whether you want to have an active approach or passive approach, these are things that individually people have different preferences on. Now, if you look at long-term wealth generation, typically what you will see is bulk of your returns actually come from an asset allocation standpoint, right? The portfolio design and the asset allocation together contribute more than 94% of the returns that you generate from a long-term perspective. And security selection and market timing only contribute, 6% of that. So when it comes to long-term investing and especially, wealth building, we do recommend to take a more passive approach in that matter. But having said that, it does not mean that you cannot invest into any active strategies. There might be some merits to investing into active strategies, especially when it comes to, say, for example, there are emerging markets and the information is not not available in the same manner, in a same transparent manner as it is available in more developed markets. So there might be merit of using an active approach in that particular segment. Similarly, there are certain asset classes where, we as, if we invest in more dollar denominated terms, there are taxation aspects and other, currency conversion aspects that you need to take into account. So for example, when it comes to fixed income investing, there might be merits to invest into, funds instead of ETFs, where you can optimize for withholding taxes, dividend withholding taxes, as well as currency conversion costs and things like that. Once you have done this, I think a couple of more important points when you are thinking of investments is to also have diversification built into your portfolios. Don't be overexposed to certain sectors, certain geographies, or certain asset classes. So if you go on to the next slide, it shows that. So while I think this looks like a lot of colors within this particular chart, but if you were to map it out, just focus on each particular column and just focus on the top row, and what you will see is that there is no one color that dominates that particular row, right? And that basically depicts to you that each of these colors represents different kind of asset classes. And what it is really telling you is that during different years, different asset classes can give you, the best returns. So this particular chart is, stacked based on the worst performing to the best performing. And even if you, see REITs as one of the asset classes that does figure, 3-4 times in there, you should be cognizant of the fact that while on 1 year it can give you very high return, 2007, 2008 financial crisis was all about real estate, right? And that, could have devastating impact onto your return. So if you're very concentrated on just one asset classes or geography, that can have implications in terms of, what kind of journey you have from your investment perspective. So it is very important to have a diversified portfolio, and that is really depicted from the white or the gray part of the, this particular chart. The gray determines asset allocation based portfolio, and while it does not always give you the highest return, but it gives you, decent returns. And again, if you go back to the principle of goal-based investing, we are not really trying to solve for beating the market. We need to solve for achieving our goals. And if that is the core premise, then having a diversified portfolio is very important. All right. Now, I think now that we have covered most of these aspects with respect to defining your key, investment objectives, thinking of your investments from a goal-oriented manner, I want to focus a little bit more on Syfe and how Syfe can help you invest in more purpose-driven manner as well. So if you go on to the next slide, what you'll realize is Syfe's suite of products have been developed to really cater to the core investment needs of clients. So when it comes to savings, we have a cash management solution. It gives north of 3.7% projected returns. And the good news is there is no lockups, there is no limits, there is no tiers. So this is a totally liquid solution that is available for you. Moving on to the income bucket, we have, as I shared earlier, we have an income plus portfolio. It helps you to gain passive income. It gives you monthly dividends directly to your bank account. Currently, the dividend range is between 4 to 6%. And by the way, this is just the dividends that you get into your bank account on a monthly basis. The actual total return from the portfolio could be higher or lower, depending on how the overall markets are moving. But right now, both these portfolios, there are two portfolios, a preserve and an enhance, and these have what you call as the yield to maturity, which kind of gives you some sense of the longer term returns from these portfolios. They range between 6 to 8%. So from a total return standpoint as well, it looks fairly attractive given that interest rates have increased. Even a lower risk kind of portfolio fixed income solution is giving you high single digit returns, which is fairly attractive in my opinion. Similarly, on the REIT side, it also gives you very good passive income. As I shared earlier, REITs by structure are required to give 90% of their income as dividends to shareholders. And that means that you can look forward to regular, stream of dividends coming in from REITs. And right now, REITs are also yielding 5.8%. So that's pretty high. Of course, by investing into REITs, you do take some equity risk as well because they are not instruments which are exactly similar to fixed income. They are listed on the stock market, means their prices do move up and down. And typically on top of the yield that you're generating, you can look forward to some sort of capital appreciation over the long term through your REITs investment as well. Once you've solved your income bucket, then if you move on to the growth side, we have constructed these globally diversified portfolios, and they are designed to kind of, again, meet your essential long-term financial goals. And they constructed using a mixture of global equities, bond, and gold. And again, going back to the slide that we had where we talked about, as your investment time horizon increases, your allocation can shift from, bonds to equity. There are 4 options from a defensive portfolio all the way to an equity 100 portfolio, where the equity allocation increases from 20% all the way to 100%. On top of that, we also are cognizant of the fact that a lot of investors want to follow certain mega trends, as well as they want to invest into, areas where they have high conviction in, or they want to align their investments to their values. So to keep that in mind, we have these thematic portfolios which help you invest into certain specific sectors or mega trends or country, right? So we have the China growth portfolio, we have a disruptive technology portfolio, and in terms of value alignment, there is also the ESG and clean energy portfolio. On top of that, these are the more managed solutions that cater to the core investment needs, again, savings, income, and growth. But we also realize that you potentially want more control, and if you want to dabble into and if you're an advanced kind of an investor, then you want to personalize your investment to your specific attributes, then we have a custom portfolio builder which you can use to construct your own portfolio from scratch, or you can invest into single securities through our trade platform that gives you access to thousands of stocks in the US and the Singapore market. All right, moving on to the next slide. If you go on to the first part, so how do you optimize for savings, right? Like with Syfe, essentially we have our cash plus portfolio, and if you compare it against the traditional ways that you typically invest your savings, it will be either fixed deposits or SSBs or T-bills. Now, typically the yields from these instruments tend to be a little bit lower compared to the yield that you are generating from our cash plus solution. The good news is there is no lock-in. The cash plus solution is totally liquid. You can come in at any point of time and you can come out at any point of time. With fixed deposits, obviously you have to lock in your money, right? So if you're ready to lock in, then yes, that could be fine. But otherwise, if you have an emergency need, then if you need to break that fixed deposit, that typically comes with certain penalties and all, right? So there is the withdrawal penalty that comes into play. And then you might also have limitations when it comes to like SSBs, T-bills and all. There are limitations in terms of minimum and maximum amount that you can invest in. Also, these only come in, say, on a monthly basis. So you'll really have to wait, and allocation is not guaranteed that if you'll get the exact amounts that you want for you. Versus in Cash Plus, there is no minimum, there is no maximum. You can invest as much as you want or as little as you want, and you can get the projected return of 3.7%. All right. So just focusing a little bit more on our Income Plus solution, as I shared earlier, the yield that generates from the Income Plus solution currently stands between 6 to 8%. They do give out dividends on a monthly basis, currently standing between 4 to 6%. And the portfolio itself is composed of actively managed funds by PIMCO, and they are also advising us in terms of how to allocate within the different funds in a manner that is forward-looking and captures, the trends and future direction of the fixed income market as a whole. These portfolios are also optimized for dividend withholding taxes because, they are Irish domiciled. So typically you will not be exposed to, withholding taxes the way that you are exposed to through US domiciled funds. These are all SGD denominated. So there is no currency conversion needed for, the dividends that you are generating. All currency conversion related aspects and even the foreign currency risk is completely hedged. So that basically means you have a much more consistent flow of dividends coming to you on a regular basis. Also, in terms of fees, usually, you will see that the Income Plus solution, we are using institutional share class funds. And that means that, your average fee, and even though these are active funds, it's pretty low at 0.65%, versus when you are trying to buy individual unit trusts through retail platforms, you can be paying north of 1.5%. Similarly, on the ETF side of things, while again, I'm a big fan of ETFs, and typically I would invest all my growth related aspects through an ETF solution. But when it comes to fixed income investing, there might be some aspects that are not the best when it comes to ETFs. There could be issues in terms of liquidity. There could be issues in terms of dividend withholding taxes. There can be issues if the ETFs are USD denominated, then there is a conversion aspect that comes into play as well. So again, we have been very thoughtful in terms of designing the income plus solution such that you are able to capture, very high yields. But at the same time, the portfolio is optimized to make sure that you are very efficient in terms of whether it is dividend withholding tax or currency costs or fund level fees as well. Oh, yes. So before going into the growth part, I think, with the introduction of our income solution, we have really completed the suite of our cash and income solutions for you. And you really have a choice now, right? Like, if you want to generate decent yield, but you don't want to take too much risk, you can take the cash plus solution. If you want to generate higher yields, then there is the income plus preserve and enhance. The preserve, obviously, lower yield compared to the enhanced, but it is much more, stable. So you see the risk rating moves from very low to moderately low, and then on to high with the REIT plus portfolio, which also gives you a little bit of, extra juice on the growth side. All right, next one. If you look at it from a growth standpoint, I think typically when it comes to growth investing, many people, as we saw earlier as well, you invest into stocks, ETFs, and a bunch of other things. If you're looking to invest for the long term, one way to think about it could be utilizing our core portfolio solutions, and these are pre-optimized for you, so you don't need to do the homework. We have done that homework for you, and we keep it optimized by rebalancing it from time to time as well. And they're globally diversified across asset classes and personalized depending on what your time horizon and risk appetite is. So if you again have a lower risk appetite or you have a shorter time horizon, you can go with the more defensive portfolios. But if you are trying to invest for the next 20 years for your retirement, then maybe you can take the more growth and equity 100 options. And then on top of that, we emphasize on the core satellite framework when it comes to investing. And what that means is, for even your long-term goals, it is important to make sure that you have a very stable base. And then on top of the base, you can, sprinkle some of your high conviction ideas. So if you are very, very gung-ho on, for example, right now, AI, and you think that AI will disrupt everything and you want to get exposure to AI stocks, go ahead and invest into some AI stocks, but don't make it too concentrated, because if you do, and if some of these stocks, and if the bubble continues to grow and you invest a substantial portion, then there can be a lot of volatility, and because of that there could be drawdowns. And this is something that we all experienced last year. This is exactly what happened. Post pandemic, everyone poured into growth investing, mem stock investing, and investments into products such as ARK, which is a very popular ETF in the 2020-21 and beyond period. And these came, falling down in 2022 last year, as soon as the Fed started increasing interest rate. And that made a lot of investors realize that while these can give you very good short-term, uplifts, but the downfall can be, even more spectacular. So you don't want to compromise on your long-term goals by, these kind of events. So it is important to have a stable core and then sprinkle some of these aspects on top, such that even if some of these don't pan out, you are still on track on your goals. Cool. And I think, if you want to think about it overall from a very holistic standpoint, this graph should help in terms of illustrating where all of these different solutions fall in terms of risk, return, and specific objectives standpoint, right? So cash plus, as you can see, very low risk, and lower return. Income, slightly higher return, but, slightly higher risk as well. And then when it comes to growth investing, you have your core and the satellite, where the core is still very diversified. So overall risk is, slightly lower than your satellites, where the risk is much, much high. and the returns can be a little higher as well. I think that brings us to the end of my section in terms of thinking through your investments in, number one, objective-based manner, and number two, mapping it out based on goals and prioritizing between those different goals. And once you have done that, how do you optimize based on, asset allocation and, individual portfolio selections as well. Now, to corroborate it further, I would bring back Jason. Jason, is your mic better now?
Yes, I'm back. How is the audio on my side?
Very good, very good.
All right, wonderful, wonderful. Yeah, so little technical glitch. Do apologize for that. Right, but yeah, I think Ritesh, what you covered earlier with regards to like the different portfolio offerings, and especially actually about the rule of thumb. In my advisory talks with clients one-on-one every day, actually I am pretty surprised that most of them actually haven't heard about this rule of thumb before. And I think that is pretty actually pretty useful way of calculation in terms of the allocation. Right. So right now what I will do is we will dive into the portfolio picks of our actual clients itself. Right. So if you do see your face here, obviously these are clients that have actually came in and spoken to us, and they are very comfortable with actually sharing about their case allocations itself. So I do think let's take this as a learning opportunity most of all. Right. So the first client itself, Tai Lim, 46 years old. All right. He's been investing with Syfe for the last 2 years itself. Right. So you can see a bit about a brief description about what he actually invests in, right, as well as some of his personal convictions over here. Right. So just to give a broad level overview for those of us who are on mobile, right? So the numbers may be a bit small, right? But basically, Tai Lim actually has 30% into single stocks and ETFs, another 30% into unit trusts, 20% into Syfe managed portfolios, additional 10% into our REIT Plus portfolio, and the remaining last 10% split into bonds and fixed deposits itself. Right. So for Tai Lim itself, it's pretty comprehensive. It's pretty, I would say, spread out across the different asset classes. Right. So how we will do this section itself is mostly in terms of a more Q&A style. Right. So I'll pose some questions to Ritesh, and then obviously Ritesh, general comments itself. Right. So maybe Ritesh, what's your general comments based on Tai Lim's portfolio?
I think first thoughts come to my mind is, how he is thinking about his, his investments from a standpoint of the goals that he has in mind. Given that he's 46, I guess he's at a juncture where he would be starting to think a little bit more from a standpoint of, how do I prepare for my retirement? Right. So I think, if you look at his portfolio right now, it's actually tilted a little bit more towards growth oriented investments. He's got like single stocks and ETFs. At the same time, he's a bit conservative, right? Like, he invested into SGX and more local stocks because that's what he understands and he knows. And slowly, I think over time, he has moved to, say Hong Kong and other markets as well to invest into high conviction ideas. Now, from an overall standpoint, what I can see is the growth aspect is still dominating his portfolios with single stocks, ETFs, unit trusts, and the managed portfolios on the Syfe side, which is also still more equity 100 and thematics. And the REITs, bonds, and FDs only contribute 20% of his current allocations. As he's moving closer to his retirement, this is an area which he can focus a little bit more on. And again, if we put the frameworks of income versus growth, if he has to prioritize, I think his prioritization will move as he moves forward as well.
Agree. Yes. So I think when it comes to a brief summary, maybe this is a chart that could actually help us when we split, like say, for example, growth focus and income focus as well. So right now on the left-hand side, I think we do see like for growth, it's more towards 80% and income is more towards 20%. So I think the idea here is that as we move closer to retirement, then that balance itself would shift to a more 60-40 allocation itself, right, Ritesh?
Yeah, so I think in terms of where he is right now versus, how he could orient himself to prepare better for retirement, if you go back to the previous slide, you would observe that there is a lot of single stocks and ETFs, as well as some unit trusts in there. Now, if he has to reorient to a more income-oriented strategy as well, what I realize is on his income front, the only major chunk that I see is the REIT Plus. He might have certain unit trusts that might be generating some income as well, but it's not very clear if that is the case. But what could be done is potentially he could look to channel some of his investments from these unit trusts and single stock investments into more income building aspects, right? And that can help him prepare better to kind of cater to a more retirement like income stream. And as he moves closer to retirement, the allocation will naturally keep drifting more towards the fixed income side.
Agree. Yep. And I think when you bring up the income related aspects with regards to the unit trust, is there a particular reason that you're mentioning or rather highlighting this, Ritesh?
Yeah, so see, typically what happens is, and again, I'm not sure which platforms he uses. Unit trusts typically are very high cost in nature, north of 1.5%. And this is where I would really look into the details of what these unit trusts are. Are they investing again into high conviction ideas? And there is a justification to it, maybe that could be justified. But if it is really about broad-based access to the market, then there could be better ways to be able to do it. And specifically more on the income side, I think, like as I mentioned earlier, for example, our income plus portfolio, it takes into account the fact that you're investing into institutional share class of these unit trusts. So, again, even from a bond investment standpoint, there might be merits of investing into mutual funds and in unit trusts, but then are you investing into the right kind of share classes? And specifically, these aspects can have significant impact in terms of the net returns that you're generating. Plus, in terms of selection of these bond funds as well, if he has to do a lot of that homework, versus like if he can do it in a managed portfolio basis, then that burden again gets taken away for him. And as he again moves closer to his retirement, I think it is important for him to have a more automated manner through which he can invest, rather than trying to do a lot of dabbling into single securities.
Agree. And especially on this last point that you mentioned, like as you move closer to retirement, I think the focus here is also like you want to spend time elsewhere rather than having to spend time actively choosing. Agree. Yep. All right. So yeah, I mean, a brief description about what we could possibly be looking at, 60-40 allocation. Right. Ritesh, any further comments, or shall we move on to the second client?
Yeah, let's move on to the next one.
All right. So yeah, so over here we have Sean Stewart, age 32 this year, right? And in terms of a portfolio allocation basis, 60% into single stocks and ETFs, 20% into unit trusts, 15% into Syfe portfolios, 19% into Syfe portfolios, and of course, remaining last 1% into the Cash Plus portfolio. So I think for Sean's case, he's actually a pretty aggressive investor, right? But of course, in terms of the entry strategy, he adopts a more DCA approach, basically spreading his investments on a monthly recurring basis, right? So obviously, his long-term goals are more towards financial retirement, I would say, as well as maintaining his family expenses over there as well. Yep. So,
right.
Ritesh, what quick comments? What do you think about this portfolio? I mean, at first glance, it seems like there is actually a very, very high weightage to single stocks, ETFs, unit trusts as well.
Yeah, no, I think it's very interesting to see Sean's portfolio. He's 32. I think he's got time in his hand. And I think I love the mantra that he has in terms of time in the market is always better than timing the market. And that I think like if there's one thing that I could have done different with respect to my own investments, would have been to like start early and just remain there in the market and go through the ups and downs. So I think as a philosophy, it is great for him to have that aspect kind of ingrained. Because when it comes to investing, there could be periods where the markets are just not working for you, and people do get perturbed by those aspects. And if you just give up, then potentially you just miss out on all the upside because you only see the downside and you go out as a disgruntled investor. Versus in this, what he's also complementing his portfolio is he's taking that dollar cost averaging strategy. And that's huge because, for him, these are the prime years where he's, making money, he's, generating income. And if he can save meaningfully during this time and deploy those savings into investments, that can really help him compound his wealth over the long term. So I think generally speaking, I love, the way that, Sean is thinking about his investments. And, more important than the actual investments, these core fundamentals that he's incorporating in his investment strategy, which is to remain in the market for the long term and employing the dollar cost averaging strategy, will really help him, build and accumulate wealth for the long term.
Yeah, I like the point that you mentioned, core fundamentals, because I think a lot of investors usually when they start off with the next how would I say, like the next hot investment as well as the investment tips. So a lot of times it does really boil down to the core fundamentals itself and really abiding by those guidelines, or even some would call it principles, I would say. Yep.
Exactly.
Yeah. So I think for Sean wise also, one thing that I like to point out over here is actually everyone is unique in terms of their own personal situation. Like I'm talking to a 30-year-old male, single, is very, very different from a 30-year-old male, but he has a family with 2 kids, right? Like in terms of the allocation and the priorities in life.
Right. Actually, yeah. So if you then take it a little bit further, right, because this is, from a core basic standpoint, I think his basics are good. Now, when it comes to matching his investments to his financial goals, if you look at it, he wants to save for his family expenses and he wants to retire in the long term. So while he's doing DCA, while, he's building some of these pots, a few things that he could consider in respect to his investment is, number one, I think he's got a very concentrated portfolio. He's got a lot of single stocks. He could consider diversifying into more ETFs and managed solutions, such as, say, our equity portfolios and core portfolios. So they are like, managed, globally diversified and optimized for him. Similarly, I guess, like, when it comes to the specific family expenses that he's trying to cater to, he can have a specific allocation and a pot designed for that as well. Right now, I think he just has the REIT Plus portfolio that might be generating him certain, small income, but that would be negligible. There is Income Plus Enhanced that I see as well, but again, not very clear how much he's investing. Given his profile, I assume it will be a very small portion within that 15% bucket as well. And even the unit trust, if you add it up, I don't think he's got more than 10% in income generating assets at this point of time. So if he really wants to save for his family expenses, he could perhaps consider getting to, close to 20-25% in more income generating sort of portfolios and have a more diversified the growth aspect, but reducing it to 70-75%. And within that 70-75%, allocating a little bit more, diversified manner into managed strategies as well.
Yeah. So I think maybe this slide would sort of crystallize what you're mentioning as well, right? Like when it comes to income, 15%, and then you go more towards a 20-25% allocation in this regard. Yep. Right. We do have a question with regards to our first investor, so maybe let's just swing right back, Ritesh. Right. So the question came from Chris. Chris, thanks for your question on this. So Chris is actually asking, like, for Thailand himself, yes, 46 years old, but that's still almost 20 years away from retirement, assuming he retires at, say, 65 years old. So in terms of this 20-year time horizon, wouldn't it still favor a little bit more equity side tilt rather than, and then when you're getting closer to retirement, maybe say 55 or 60, then you do that reallocation itself? What's your thoughts on that, Ritesh?
Yeah. Look, I think every investor, as I said, is unique and different, and they might have different kind of risk appetites. So don't take this as, this is what should be the allocation. 60-40 has to be the allocation for him. It's just a guidance. The idea generally is that he will start moving a little bit more towards income generating assets as he gets closer to retirement. Now, he might have a goal to retire in 10 years, right? Like, while our friend Chris, you might think to work to your maximum and retire at say 65 plus. But if he wants to retire at say 55, between 55 to 60, then I think he needs to start preparing much earlier, right? So that ways, I think the context needs to be there. Your time horizon needs to be mapped accordingly. And again, don't take it as a hard rule that it has to get like 60-40. It is just again a guidance. And on top of that, I think what tends to happen once you are closer to the 50-year mark, you really want to carve out a specific passive income oriented strategy for yourself. So that is really the intent with which we or I mentioned that he could have a higher allocation to fixed income, because I think right now, while he might have a decent allocation to fixed income, it is not a very coherent strategy. It is kind of spread across a bunch of things. There is some REITs, there is some bonds, there is some FDs, and there might be certain unit trusts, but it is not very structured at this point of time. So as he gets closer to retirement, perhaps he can structure it better, and that's what he could focus on.
Yeah, and this brings to mind actually, like earlier you were mentioning in terms of the three buckets, like growth, income, and savings, like how we can actually look at these three buckets and then decide on an allocation unique to our own situation itself. I think that really makes a lot of sense in terms of how we can actually view our portfolio. Right. Next question we do have from a client itself. And before I go into this question, we'll take one or two more questions. And if you have like specific questions about your own portfolios, feel free to bring it up on the Q&A aspect. We'll be able to actually answer them, not in detail, right? That usually takes a longer session.
Or actually, I mean, as you all know, we have a dedicated advisory team, including Jason and Melvin. So do reach out to us. I think Melvin can share the link for you to connect with us. If you are an existing client, you can just go on to your app, and there is a way for you to connect to your advisor. And if you are new, then basically there is on our website a way for you to schedule a free call with us as well.
Yep, that's right. So Ritesh, even I don't have to say that, but you actually said it. Yeah, but so anyway, this is the link itself. You can just send us an email at advisory@syfe.com, or in fact, like what Ritesh mentioned, just go to your app and then just connect with an advisor. Right. So question came in. This client, 30-year-old single, and he's looking to invest in Syfe. So he's a non-Syfe client. And I think he's asking in terms of commitment-wise, is it okay to actually fully commit to just Syfe managed portfolios and then have single stocks or ETFs as a much smaller percentage, right? And of course, there's a bit of a context over here where he's looking at a 10-year time horizon. And obviously, in terms of the initial capital, it's a six-figure sum itself.
Sure. So look, as I shared earlier, if you're trying to, I think first and foremost, you really need to define your goal, right? Is it a savings goal, a growth goal, or an income goal? By the looks of it, it looks like it's a more growth-oriented goal. And in that matter, again, I think the focus should be a little bit more from a core satellite investment framework. Now, from a core portfolio standpoint, the idea really is that you need to invest in a diversified manner across asset classes and across geographies and sectors. So either you can have your own strategy to invest in your core aspects. So if you can construct your own portfolio and manage it efficiently, then you can do it, right? Like there are ETFs and all available. And even on the Syfe platform, on the trade side, you can pick, global ETFs and then you can invest into them. The only thing is, time is money, right? Like, do you want to spend that time you really thinking about and optimizing, or you want to give that to us where we manage it at a very small cost to you? So if you don't have the time, then we will take that piece and we will manage it for you. That's what the Syfe core portfolios are all about. Once you have mapped out your core portfolios, typically we say that at least 70% of your investment should be in a globally diversified manner, right? And if that is Syfe portfolio, then yes, I mean that can help as well. Beyond the core, then depending on your specific convictions, ideas, values, you can take exposure to satellite strategies. And these are things where you can dabble into individual stocks, you can dabble into individual sectors, you can follow mega trends, you can invest into specific, trends that are emerging with respect to, say, AI and other things and all as well. But again, that portion needs to be a much smaller portion, because again, when it comes to realization of your goals, even though it is 10 years apart, you want to get to, I mean, there are two parts, right? Like one is getting to your goal, and then the second part is the journey to the goal. Do you want a very rocky journey where every night you wake up and you're worried about your portfolio, or you want to, go through that journey in a reasonably, comfortable manner? So that's where the diversified portfolio comes in, the core portfolio comes in, to give you a much more smoother ride. And then your high conviction aspects, you can, sprinkle it on top, which becomes your satellite.
Yep. And okay, so the next question, which is, I think, a very, very interesting question, has been brought up multiple times in our advisory sessions, which is, how do you consider and combine pension funds, like, for example, CPF, 401k, right? And how do you combine these pension funds together with a retirement strategy using income?
Yeah, I think that's a great question. Typically, what everyone will realize is, like, for Singaporeans, when it comes to average cost of retirement and the monthly sort of income stream that you need to retire, even on an average standpoint, like average lifestyle standpoint, it typically comes around $3,000 to $3,500, right? Now, and that just caters to your basic retirement needs, by the way, right? So that is the amount that you need to have on a monthly basis to, get a a basic retirement in Singapore. If you want a more comfortable and a premium lifestyle in your retirement, you're looking at north of $5,000 a month that you need to generate during your retirement and golden years. Now, typically, CPF gives between $1,000 to $1,500 on a monthly basis, right? So what that means is there is a significant gap which you need to think about and cater to and really invest for, to plug in that gap, right? And that's where the investment framework comes into play. So you can have a perspective that, okay, I will generate $1,000 to $1,500 through my CPF, but that only caters to part of my income needs during retirement. What about that other $3,000 or $4,000 that I need to get me the lifestyle that I want? And for that, you really grow your wealth. So the phase that you need to go through is, like, if you are a 40-year-old, a 30-year-old, you need to invest in growth-oriented assets such that it grows to a certain lump sum. And as you get closer to retirement, your strategy moves towards more income-oriented assets. And at retirement, then you can convert bulk of your investments into income generating assets. And typically, if you think about it, like, if you have $1 million at that retirement age, and if that generates you 3 to 4%, then that converts to roughly $30,000-$40,000. And if you divide by 12, that translates into that $2,000-$3,000 as well. So you really need to then think through, CPF will cover me from the perspective of getting part of my income needs catered to, but the other part that needs to be then solved for, I need to invest now to get to $1 million or a $2 million lump sum, such that that generates me a certain yield, and that solves for the gap.
Yep, agreed, Ritesh. And I think this conversation actually comes up pretty often in our one-to-one advisory sessions as well. So once again, if you're joining us here today in this evening session, right, and if you are a Syfe client, or even if you're not a Syfe client, do feel free to actually approach one of the Syfe advisors to actually speak in terms of your personal situation itself. Right. So I think before we end today's session, we are a few minutes past our initial timeline. So this is just a quick promo code, sort of to nudge our new clients a little bit. Right, so we do have a 6 months fee waiver, right? And when you actually create an account, just go to the promo code section and key in this promo code. Right. So Ritesh, before I end the session, perhaps any last words for our audience here tonight?
I think, as I mentioned earlier, map out your key objectives, invest according to your goals, and more importantly, stay invested and DCA.
All right, wise words. And I think if I can just add on a little bit to that aspect, is everyone's unique, and unique allows us for individual situations. So we do have to really think about our own situation, right? And obviously having the advisor to guide you along does really help and play a huge role, in fact. All right. So if not, that's all for this evening session, folks. Thank you for joining us, and we look forward to speaking with you again soon. All right. Thanks a lot, guys.
Thank you.